Welcome to another episode of the Payment Strategy Show. I'm Brooke Smith, the content manager at Rainforest. We're the embedded payments provider purpose-built for vertical software platforms to help you drive more processing volume at higher margins with a payments product your customers love. I'm here today with Rainforest founder and CEO Joshua Silver, otherwise known as your usual show host. And we're going to go deep on ACH because this is a topic that a lot of modern payments providers just don't talk about enough, but it's still highly relevant to software platforms. So Joshua, thanks so much for joining us.
Good to be on the show on this side of the table for a change.
So Joshua, I know there's a perception that ACH is obsolete, that it's like an old VCR. So why should we care about it?
Well, it's a good question, Brooke. I think a couple things. First of all, just the sheer volume. ACH moved $86 trillion in 2024. In the same year, total card volume was around 12 trillion. So that means that ACH volume was actually 7 times card volume. And not only that, but it's actually growing. There's an assumption I think that most people make, which is that ACH usage is declining. The opposite's actually true. Network-wide ACH volume was up 7% year over year from 2023 to 2024. And not only that, but same-day ACH volume increased by 45%, which was more than double the growth rate from the previous year. And so as the economy continues to expand overall, ACH is taking up a huge portion of that. Consumers love their credit cards, Brooke, especially the rewards, but ACH is still really the backbone of underlying money movement.
Yeah, I couldn't agree more. So what is ACH? How does it work? And how is it fundamentally different from credit cards?
Yeah, so ACH stands for Automated Clearinghouse. It is a payments network that's been around several decades now. It's essentially how the vast majority of low value transactions move through the US banking system. Every US bank is connected through the Federal Reserve. They run the primary ACH payments network. Every bank pretty much is connected to it and has a very specific set of rules governing cutoff times, amounts, the rules for disputes, everything related to ACH. It's one of the only rails that is completely ubiquitous for all different banks. It is a batch-based process, meaning at certain times throughout the day, banks gather all of the transactions, whether it's payments going out, ACH credits, or ACH debits pulling money in to the account. They gather all these transactions into a batch. They send them to the Federal Reserve. The Federal Reserve then takes them, does a massive sorting operation, and then sends them out to the recipient banks. Those banks then have a certain amount of time, usually an hour or two, to post the transactions. And this process happens several times throughout the day and into the wee hours of the night. It's fundamentally different than credit cards in a couple ways. One, it's not real time. So when you enter in a routing and account number, there's no way to validate for sure through the official payments network whether the account number is good or whether it has money in it. Unlike a card, a debit or credit card, which does a real-time authorization and effectively guarantees the funds. So you're operating certainly on a bit of trust with the ACH network rather than having kind of that for sure authorization. At the same time, payment costs with ACH are generally much, much lower than cards. And there's no concept of float with ACH like you have with a credit card where the consumer has a month or even more to pay off their credit card bill. With an ACH, it's pretty much immediate. When that effective date hits, that money is going to move.
Those are all really important points. The other thing that stands out to me as a difference is that with card processing, we have this very fixed definition of a merchant and a buyer or a payer.
Yep.
And in ACH, it was sort of designed to be symmetrical. So we don't have a fixed concept of the merchant as being different from the buyer. It's really just a question of who is sending the instructions.
That's right. You have two sides in an ACH transaction. You have the originating side, or the ODFI, which is the bank that's sending the transaction, and you have the RDFI, the receiving bank that's receiving that transaction. And so both banks send and receive the transactions this time, but next time it could be completely flipped. And you're absolutely right. It is both a pull and a push mechanism. And in fact, in terms of actual official payment rails in the United States, it is the only pull mechanism. Things like wires are push. RTP and FedNow, which are instant payment rails, are both push only. You cannot pull funds. And so ACH, if you're trying to pull money from a business or a consumer, still is the main way that it works if it's going through the banking network outside of the card rails.
Absolutely. And I think that's one of the reasons that it's still so very relevant to payments providers and software platforms. So, why do ACH payments take days to complete?
Good question. So, with ACH, a couple things. One, it doesn't operate 24/7, 365. It only works on banking days. And so if you send a payment on a Saturday morning, for example, that's not even going to start moving through the network until Monday at the earliest when that effective date could be. Second, you have everything that goes in batches. There is the concept now of same-day ACH. And so if you send the money earlier in the day, you can have the effective date be that same day and the money will move that day. In general, the vast majority of the payment volume is overnight, meaning a Monday transaction's effective date is on Tuesday. That's when the money actually moves between the banks. What that doesn't account for is risk. Thinking back to what we talked about earlier with credit and debit cards, when you get that real-time authorization, that is essentially the card networks guaranteeing that those funds are good. With ACH, you don't have that same guarantee. And so oftentimes the processor or the bank will sit on those funds for a couple days because they want to make sure they're good. There's a couple of ways that they may not be good or may have a return or bounce. One could be an administrative return. These are things like you just entered the account number wrong or the account number is closed. Those returns generally get processed through the ACH network within 2 or 3 days. And so some payment providers will hold the funds for those 2 or 3 days because they want to clear the return window and make sure that there's not kind of a dumb error. You also have things like insufficient funds or NSFs. That means that it was the right account, but that payer didn't have the money there and the bank returned it. And those can be really costly for merchants and payment processors if you thought your $10,000 transaction was good and then 3 or 4 days later you get a notice back that it wasn't in fact good. So there's oftentimes these hold periods that the payment processors will put in place to help manage the risk.
Yeah. And I know a huge part of that is because when we look at an embedded payments use case, or even just sort of a vanilla commerce use case where the merchant's bank is the originator, and we have to use that pull motion, we have to do an ACH debit, the recipient or the ODFI doesn't know that there's money in the bank. They don't know that it's the right account number. Right. So in a perfect world, it's tempting to say, well, why don't we just use push payments? Why don't we just have the payer push funds to the recipient? In reality, why doesn't that work?
It's really all about the user interface. It's a question of how do you get a consumer who may be on a web page or even paying a paper bill to go into their bank and push that payment out. Some other countries have really figured this out and they've done a great job with it, primarily through the use of QR codes, and all of the bank apps have the capability to respond to that QR code and the workflow built in. Consumers are conditioned to it. The whole kind of ecosystem is built around this concept of push payments through the banking rails. Unfortunately, the United States was so early in the electronification of its payment systems, decades ago, that none of these technologies existed. And so the core network doesn't really support that. What we are trying to do as an ecosystem now is to retrofit this concept on top of the existing rails. And in all of the new real-time payment channels, both RTP, real-time payments, as well as FedNow, which is the federal government's version of real-time payments, they have what's called an RFP, a request for payment. And what that allows you to do is allows the merchant to send a request to the consumer or the payer's bank and say, I'm requesting $50 or $50,000, whatever the amount is. And then that payer needs to go into their bank app and approve the transaction. Unfortunately, very, very few banks have built the enablement layer for that. And even if they have, I've tried it a couple times, the user interface is just really clunky. It really breaks the flow when you're trying to check out. And so it's the overall adoption of that is extremely low. And I think if you've ever used Venmo, you probably know what this looks like. In Venmo, you can request your friend to pay you back. They'll receive a notification saying, Joshua's requesting $75 to cover dinner. Would you like to accept that request and pay it out? Yes or no? Same exact concept, but trying to make that done through, instead of one Venmo app, hundreds or thousands of different bank applications. That's the challenge.
Yeah. On top of that, is the issue of reconciliation. Because if we turn all of these payments into push payments, they're going to be a lot harder to match to the correct customers and invoices on the back end. I think this is why utility companies almost exclusively use ACH debits to collect payments, because they create the ACH file. They know exactly which payment matches to which customer and which account. In embedded payments, we're looking at the same trade-off. By using debits, we can create this really clean reporting and reconciliation experience that saves a huge amount of time and headache on the back end, instead of going line by line trying to match inbound payments to the right invoice.
Yeah, and it's a really tough challenge, because when the banking networks were created, this was back in the days even before dial-up internet, right? It all kind of predates that, and so space was at a premium, both storage space and transmission space, and so the record format for Notch is actually really compact. It's a fixed width format, meaning each field has X number of specific characters. The name can take up X number of characters, and the amount can take up Y characters, and so on. There's not an opportunity in general to put too much information in there. And so it's hard to get universal ID numbers and items to help with reconciliation. They did later add on this concept of addenda records where you can add a bit more information. But again, the coverage of that's pretty spotty. And most times the software platforms don't even get access to that underlying information. It's buried so deep in the pipes, if you will. So it is a real challenge.
Yeah, the best way to make things reconcilable is to use those debit entries. So when we're talking about debit, we have to deal with ACH returns. I know you touched on this earlier, but how are they different from credit card chargebacks?
So with ACH, there's really two different kinds of returns. There's those first kind, which we talked about earlier, those administrative returns. We don't even know when we start originating a ACH debit entry if the account number is good, or if it's still open, or if it's authorized. And so all of these basic checks don't have failures in the card world, because you know right away it's good or not. So there's a whole added layer of additional types of failures or returns that you just don't have, period. Then when you get into disputes, ACH has two different timelines for disputes. Business debits, when it's coming out of a business bank account, they only have a couple days, typically 2 or 3 days, to say this is unauthorized, it needs to be returned. And that's because they expect that businesses are watching their bank accounts closely and have professionals doing it. With consumer accounts, you actually have several months to initiate a dispute. And you do that by going through your bank saying this is an unauthorized debit to my account. And generally, if you have sufficient evidence, the bank will reverse it. With ACH, it is a final reversal. The bank who's receiving the debit, essentially the payer's bank, ultimately kind of has control over sending that back or not. And then there's no evidence that kind of flows back and forth. It's a one shot and you're done. And so there's a lot of power that sits with the payer's bank. On the flip side, with the card networks, there's actually a back and forth process. As a consumer, if you file a dispute with your card issuer, they will send a notice to the merchant saying, this transaction is being disputed. Do you have evidence to suggest it was a legitimate charge? And there is that back and forth. And so you end up in a world where card disputes actually can be won in the merchant's favor or the payer's favor, either way. But there is that built-in back and forth process. With ACH, you don't have it. And so on top of not being able to even validate the account number, you then have the risk where the consumer may go rogue and just, falsely say this was a invalid or fraudulent transaction, get their money back, and you have very little recourse at that point.
So how does all of this, batch processing, debit pull, money movement, ACH returns, how does that impact risk?
Essentially, all of those different points of return and lack of validation need to be factored in when you're talking about ACH money movement. And Rainforest, along with any other payments provider, is going to implement different policies based on the transaction amount, how long the merchant's been around, what the history of returns is, whether they are going to get their money right away, whether there's going to be a couple-day hold, and also what the pricing needs to be to reflect that risk. But overall, ACH can be a lot riskier than card transactions. The other thing we see, especially in embedded payments, is that the average ACH transaction size tends to be much larger than card, because merchants oftentimes don't want to pay the fees if it's a $10 or $20 or $50,000 transaction. So you really have, this situation where the transactions are riskier and also the amounts are greater, leading to a really tough challenge. And what we've seen is a lot of credit card processors, especially the bigger ones, have ACH, but it's really as an add-on. It's not what I would call a first-class citizen. They oftentimes put really long hold periods. They have really low limits. They charge a relatively high amount for it relative to the underlying unit cost. It's not really kind of part and parcel of their solution. That's one thing I think Rainforest has done very differently is we said, we're going to make ACH a first-class citizen. We're going to put the proper controls in place, the proper underwriting to make ACH a really attractive option, even at larger ticket sizes.
And what are some newer innovations that companies like Rainforest can use to reduce risk while bringing ACH functionality, on par with other modern payment methods?
So unfortunately, the innovations haven't come from the core payment networks, namely Notcha itself, but we do have a lot of other third parties that offer different tools. And there's kind of two different types of tools available. One is instant bank account validation, and that is where the consumer or the payer is providing typically their bank username and login, and behind the scenes, a company, for example, Plaid or MX, is going and pulling information straight from the bank account. And so in that case, you are able to verify that the account is legitimate, that this user has access to it. And if you do an enhanced balance check, that there is money in the account at the time. Unfortunately, it doesn't place a hold on the funds, though, in the account. And so just because you have the money there now when we do the check, on the effective date of the transaction, if it's tomorrow, you might have paid other bills by then and there may not be money there. So that's the first kind of class of tools, is these instant validations. The second class of tools is there are a lot of different third-party databases that have information about known good and known bad accounts. For example, if a particular account's been known to be used for fraudulent purposes many times over, everyone will submit that information, kind of a consortium style data sourcing, if you will, and share, hey, we've been frauded by this account number, hopefully you won't be. And in the same token, everyone else exchanges the information as well so that you collectively build it. Unfortunately, there's still a lot of gaps in those databases. Many of them only have about 50 or 60 or 70% coverage. And so that still is a significant number of accounts which don't have coverage. And secondly, all they're telling you is if the account has generally been used for good or bad. Sometimes they'll give you a name match so you can see, is this truly the right person's account? But they don't ever have the balance information. And so it's not really helping you underwrite any of the NSF, insufficient funds risk. It's really only helping you decrease the administrative returns.
It sounds like in combination, these tools can have a huge impact.
They can. If you use a layered approach that's oftentimes based on the risk of the merchant, the size of the transaction, whether this is a repeat transaction, you can waterfall down the rules and add instant validation, bank account validation. You can do the balance checks. You can look in these databases. And so when used all together in conjunction, you can decrease the risk, but it still is not the same as credit card risk. And that's why you do continue to see differences in timing and things like that throughout the market. Plus, these tools aren't free. They know that they're saving you potentially from a return. And so there is a premium that these companies charge for access to these tools and databases.
Of course. Getting into some specific topics for software companies, why do certain industries tend to favor ACH over card?
I think a lot of it comes down to the transaction size. Anytime you have really large transaction sizes, maybe say over $1,000, you start to get into territory where the merchant doesn't want to foot the bill for those fees. And they have the choice in some cases to be able to pass the credit card fees on with a surcharge, but in other cases, they'd rather just go and use ACH instead. Some industries have really tight margins and they just don't have a lot of extra to pay for fees. And so ACH is typically their preference. Anytime when you're not shipping an item like an e-commerce situation, obviously you want to default more towards card. Other cases, a utility bill, for example, they're willing to take the risk on that return because they'll just shut your service off if that ultimately bounces and you don't make good on it. So I think, the level of recourse that the merchant has is also a big determining factor.
In industries where there's a resistance to paying, 3.5% for card payments, so ACH utilization is higher, how can software platforms that serve these industries monetize ACH, keep those payments flowing through their platform and still make some revenue on it?
I think an important thing and something that we counsel all of our clients on here at Rainforest is that Payments is generally and should be viewed as a value-based sale versus a cost-plus model. And so if you look and you say, hey, I'm paying 25 cents for an ACH, I just need to mark up a little bit and I'll charge 50 cents, something like that. That's very different than hey, we helped you get paid merchant. We help with the reconciliation. We help with the posting. We helped you get paid way faster, by the way, than if you did with a check. We help reduce fraud versus checks where you've got a lot of paper floating around and people may do bad things with them. So there's a lot of value there. And it may not be 3 or 3.5% you can charge, but typically you still can charge some percentage on it, maybe a half a percentage or a 1%. And maybe you cap it at some amount above a certain threshold that the ACH fee gets capped at $10 or 15 or 20 or 25. So I think there are some checks and balances you can put in there, but I don't think it has to be ACH as a commodity and we're only going to sell it as a commodity. I think that the value of that embed can be monetized.
Absolutely. And in industries where there's still a lot of paper check payments, I think a huge part of that payments monetization opportunity is getting those payments from paper checks in the mail to on the platform as ACH. What are some specific actions software platforms can take that would encourage both their merchants and end customers to move from paper check to on-platform ACH?
A lot of it is behavior and conditioning. So making sure that all the frontline staff, if it's field services, making sure they're saying, make sure you pay electronically, being able to send out text messages and emails instead of paper statements, because when you send paper, you're more likely to get paper back. Even potentially offering some incentives, making sure that you're able to store that bank account on file so they don't have to enter it again and again. And any type of recurring service, going to be much easier to just click the pay button or respond yes to a text message saying, can we ding your bank account on file for it than it is otherwise. So again, it all comes down to frontline staff, how you're communicating out to the end payer, as well as, is it a good user interface? Is it a good experience? Make it so easy to pay electronically that there's no chance they'll pull out their checkbook.
Yes, humans love the easy decision, and easy will win every time.
Absolutely.
So how should software platforms think about ACH within their broader payments, fintech, and product strategy?
I think the most important thing when you're trying to figure out who to partner with for payments, make sure they have a comprehensive offering. I've seen some platforms over the years, for example, try to go get one payment provider for card and one payment provider for ACH. This is a terrible, terrible option because what you're doing is you are creating a disjointed experience, not only for the merchant, but probably also for the payer, that the screens look one way if you're paying with this vendor versus another. The merchant's likely going to be having to deal with different deposits, different billing reports, different fee structures. You really need a payments provider that has ACH and card both as first-class citizens. And unfortunately, there aren't that many. It's one of the reasons we started Rainforest, but there are a few. And I highly suggest if you're an industry where ACH could be the difference between people paying electronically or paying with paper, you have to make it easy. You have to make it be a good experience so you get that adoption. That will in turn drive card adoption and it will in turn drive overall general usage of the software platform.
Absolutely. That's great advice, Joshua. And thank you so much for joining us.
Thanks for having me. I appreciate it.